What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, first up guys, before I jump into what we were supposed to discuss in this China Update, what I just prepared over the last few hours, there was a breaking development from about 20 minutes ago. Multiple sources are reporting that some offshore bondholders of China Evergrande Group did not receive coupon payments by the end of the 30-day grace period. If true, this would mean that Evergrande may have formally defaulted or is formally defaulted, which would trigger a cross default on the firm's roughly $19 billion of international bonds. Like I said, this is still not confirmed. This is from 20 minutes ago from key sources. I'm going to have more on this possible Evergrande default shortly, so make sure you're subscribed and you hit the bell notification and you'll have this analysis once it's up. The highest leadership of the party has just concluded a Politburo meeting in Beijing, which discussed party discipline inspection and 2022 economic work. The Politburo readout stressed that, quote, action should be taken to safeguard macroeconomic stability, keep major economic indicators within an appropriate range, and maintain social stability to prepare for the party's 20th National Congress. This is what the Politburo readout said. The crisis-hit housing sector was also mentioned, with the top party leadership expressing that, quote, efforts should be made to advance the construction of affordable housing, support the commercial housing market to better cater to the reasonable demand of home buyers. Now we're going to discuss China Evergrande and the housing crisis later in this video. Like I said, the Politburo readout also expressed that China needs to accelerate the implementation of science and technology policies, continue to focus on key and core technologies, strengthen national strategic science and technological forces, and strengthen the leading role of enterprises in innovation. On Monday, the People's Bank of China, China's central bank, announced a cut of 50 basis points to the reserve requirement ratio for banks. This is the second such move this year. The central bank expressed in a statement, quote, the cut will release 1.2 trillion RMB, approximately $190 billion US, in long-term liquidity and will lower capital costs for financial institutions by around 15 billion RMB each year, end quote. Many in the media are arguing that this is a significant easing on the real estate sector. While it helps, however, it is hardly significant. Indeed, the People's Bank of China itself expressed, quote, China will not resort to flood-like stimulus and will keep a prudent monetary policy, end quote. The state-run The Economics Daily, seen as a mouthpiece of the State Council, China's cabinet, also stressed that this move from the People's Bank should not be misunderstood, warning against, quote, simplistic interpretations of monetary policy, end quote, and expressing that Beijing is not about to unleash a huge wave of credit in panic, and saying that more credit could still be on the way. Hey, by the way, guys, if you're getting some value from this episode, if you're enjoying it, don't forget to hit that like button. It is the only way a small channel like this will be recommended to new people. If you're watching this for the first time and you're enjoying the content, also maybe consider subscribing. Hit that bell notification and you'll have the most up-to-date analysis when it is released. And if you'd rather listen to the episode, search China Update on your favorite podcast platform, and I should be there. Now, with the Central Economic Work Conference likely just a few days away, there is a lot of speculation internationally and within China itself regarding what the growth target for next year is going to be. The Beijing-based government-affiliated think tank, the China Academy of Social Sciences, published a blue book yesterday arguing that China's economy is likely to grow around 5.3% in 2022, down from the quote-unquote above 6% target from this year. The clearest sign yet that the Beijing elite anticipates serious economic slowdown by modern Chinese standards in the coming years. In an interview with reporters on the blue paper, a researcher at the Chinese Academy of Social Sciences put a positive spin on the lower growth rate. Quote, a target of above 5% leaves a certain room of leeway, which is a relatively prudent call. It would also allow all parties to focus on promoting reforms and innovation and pushing for high quality development, end quote. Last week, the Bank of China, one of the big 4 state-owned banks, forecast China's economic growth could be around 5% next year. Morgan Stanley forecast 5.5%, and the International Monetary Fund forecast 5.6%. Now, 5% may sound quite high for someone living in a developed country. For a country with hundreds of millions of people still earning the equivalent of less than $10 a day, such a slowdown will be felt. In response to the blue paper, Peking University professor of finance Michael Pettis expressed, quote, "Cass proposes a GDP growth target next year of above 5%. I suspect it will be closer to 5.5%. Whichever it turns out to be, it will require a revival of property and infrastructure spending and an increase in the debt to GDP ratio of at least 2 to 4 points." End quote. Late last week, Beijing also held a new event series called Understanding China in the southern city of Canton. According to state-run Xinhua media, the special conference is, quote, "sent at a time when the West's anti-China narrative, shepherded by the United States, is doubling down to portray antagonism between China and the West," end quote, and that the event, quote, "should serve as a reminder for the West that it is time for them to discard their prejudice and understand China," end quote. Showcasing the importance of the event, General Secretary Xi Jinping presented the opening address via video link at the opening ceremony. In his speech, he observed, unsurprisingly, quote, "To understand China today, one must learn to understand the CPC," end quote, here referring to the Chinese Communist Party. Some of these statements from the event give us very clear indications to understand Beijing's current mindset and worldview. For example, quote, "As China begins to play a more prominent role in global affairs, it is at a point to reverse its disadvantage in the global discourse arena," end quote. And, quote, "Facing a more hawkish anti-China campaign in the West, China's counteroffensive against Western disinformation and smear campaigns will only grow more prominent and fierce," end quote. For those of you who have been wondering whether the so-called wolf warrior style of diplomacy will continue, here is your answer: more prominent and fierce. And finally, Evergrande and other troubled developers. Over the weekend, just hours after it happening, I published a video for you guys about the Evergrande chairman being summoned by the local government. I did a deep dive into what happened to that video, so I'd highly recommend it if you want some primer on the last few days vis-a-vis Evergrande. The chairman was summoned after Evergrande told investors that the company may not be able to meet its financial obligations. Then a government working group was dispatched to take control over parts of Evergrande's business. Finally, late in the evening, coordinated statements were made by top Beijing regulators to calm markets. Chinese financial media outlet Caixin Media's team of financial analysts published a piece yesterday expressing optimism regarding these moves. The piece argues that the regulators' quote, "quick response signaled a well-prepared and coordinated effort to restore a market-shaking financial crisis following what has evolved as a playbook in previous cases," end quote. The approach followed the pattern of efforts to dismantle similar cases of debt-laden conglomerates such as HNA Group. The team of analysts concluded that the local government, quote, "decided to dispatch the working team to Evergrande after the company failed to resolve its debt crisis over more than 4 months by offloading assets," end quote. Then on Monday night, in a statement, Evergrande said that it would form a new risk management committee that would, quote, "play an important role in mitigating and eliminating the future risks of the group," end quote. The committee includes representatives from state-owned enterprises controlled by both the central and local governments. It is also being reported on Tuesday by Hong Kong and US-based financial media that China Evergrande Group is planning on restructuring, which will include all its offshore public bonds and private debt obligations. Distress among Chinese real estate firms is spreading. There are other property developers that are feeling the pain now, and we have yet another troubled Chinese property developer to keep an eye on. Chinese developer Sunshine 100 China Holdings missed payment on $179 million of debt and interest payments due on Sunday. And perhaps a little piece of good news for China Group Limited. They may see a stay of execution this week. A major creditor sent China Group an offer of forbearance to avoid a $400 million default late Monday evening. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.